Thanks, Jeff. Appreciate it.
Sorry, I forgot to do that at the beginning of the meeting.
The disclaimer,
We're gonna do it.
legal framework.
All right, I have two requests.
Jeff, they couldn't have picked a better spokesperson.
Is it possible to share the PowerPoint again? It came off our screen. I
I thought
believe
you had your
were
own
controlling
PowerPoint
it.
you're sharing.
No, it's part of the one that was already being shared.
Okay. I was trying to anticipate a meeting.
No problem. Yeah.
I was impressed though. I was sitting there
like sitting back here.
I wish I had somebody like that to make sure all my stuff was lined up.
All right.
Excellent. Thank you.
Happen.
Can you see it, Adam?
Yes, that's perfect. Thanks. And so definitely, we are going to cover some, more details here. So please raise your hand or shout out if you do have questions. It's okay if they're during the presentation or at the end. I think we have, sufficient time, so I'll kind of jump in. But so I'll talk about a little bit background on list fund management, kind of our track record, what we've done around the country, and then shift to how we're structuring the Kansas City Regional Housing Fund, and go into some of the terms, some of the products, how we're looking at it from an impact perspective, and give you updates on the timeline where we are right now. And also encourage Aaron or Catherine to jump in if I misspeak at all, which I sometimes do, because I like to improvise. So let's start there and we can go to the next slide. So this just gives you a quick overview of not overall LFM leadership, more of the leadership for this fund. And Catherine, sorry for your picture not being on here. You'll be a key partner on this project as our head of marketing. But this kind of shows you the people that would be interacting at the fund level, from Tiffany, our president, to me and Aaron on the fund design and development side, Brian Maddox, top right, who's really leading our investor relations and fundraising side. And then the bottom left and center, Michael and Ben, who lead up our originations, and they'll be working with the List KC office to originate investments and do deals on the ground in greater Kansas City. So this will give you an idea, and happy to kind of go more into our background. We can go to the next slide. So, List Fund Management, as Jeff indicated, we are an affiliate of LISC. We are a wholly owned subsidiary of LISC. We're a registered investment advisor. We are an impact investing management company and underscore impact. So we are impact first. So all of our funds have a high impact component, whether it's affordability or small business development or other community development activities. And that is it is the top priority for almost all of our decisions in terms of making sure we have the impact that we are trying to have as a subsidiary of LISC as a national nonprofit. So we have 12 funds that we manage, and I'll go into a little bit more detail on the next slide, just on the types of funds. But we manage about $836 million at this point across local and regional and national funds. What we offer as LFM is really a full service kind of fund management suite of services, from the initial phase that I'm involved in of designing funds and working with local communities and local offices like Jeff's team, up into the capital raising side. We do all fund admin activities. We do the originations. We do all the compliance, investor relations, reporting, communications, essentially everything that you would need to manage and operate a fund in this space. And that is still unique. There are a lot of people that are doing impact investing, but we have the ability to really keep it all in-house, which I think allows us to avoid mission creep for when we do launch these types of funds, that we are kind of really focused on the mission aspect and the impact aspect, but we have the capability to all these pieces here. We can go to the next slide. So this gives you an idea of the funds that we currently operate around the country. So kind of mixed between affordable housing funds and then business funds. And so I would say, LISC overall does a mix in a similar way between housing and business. We are skewed kind of going forward more towards housing, but we do have a really robust business fund portfolio as well. On the housing side, I believe these are in chronological order when we launched them. So the Bay's Future Fund was one of the first, if not the first fund we launched, which is actually comprised of three funds. And it really addressed affordability issues in housing production in the Bay Area of California. And what's similar about that fund from what we're trying to do in the Kansas City region is that this is a regional approach. It's not multi-state like, Missouri and Kansas, but it's Oakland, it's San Francisco, it goes into other areas and other counties in California as well. But also it was part of a partnership called the Bay's Partnership of the Bay's Future, which we're really trying to model how the fund will work with the Regional Housing Partnership and all of you in this room. And so we've talked about similarities, what's worked with that fund and what we can model going forward for KC. The other funds for housing are all place-based, so they're all cities. So we have Charlotte, we have Detroit, Dallas, and Cleveland. And I would say the similarities to what we're trying to do in the Kansas City region is that they're locally led, where we started with a problem on the ground and working with stakeholders, whether it's a local LISC office like in Charlotte or Cleveland or Detroit, or government like in Dallas. So all of that was kind of started with local stakeholders, a local needs assessment, and then building up the funding locally that we need to launch and scale these funds. The fund sizing, you'll see at the top of these, kind of gives you an idea. These are really the current sizing for these funds. And so typically we have fund sizes anywhere from 50 to 100 million. And the Kansas City Regional Fund is supposed to be up to $100 million. The fund with the black boxing, National Strategic Investments Impact Fund. This is a national fund, and you'll see it's the bigger, 250 million in sizing and much bigger because it's on a national scale. We have a lot of more corporate partners as investors for this, and this was really created out of the COVID pandemic and really trying to get, investments and housing created very quickly across the country. And then our business funds, these are really small business loan funds that we have thousands of borrowers in these funds, which is unique. And these are high impact. And you can see some of the partners we have on those funds as well. Just the one takeaway for all of these is that, we raise capital from a variety of sources, and I'll come back to how we're approaching it in Kansas City. But we have grant capital from foundations, from governments. We have banking partners who are really CRA motivated or just more impact investing motivated banks. And then we have a large amount of corporate partners as well. And so I think that's where LISC overall, and especially LISC Greater Kansas City, excels at bringing these people, these types of investors and stakeholders into the same room to launch these types of funds. I think we can move on to the next slide. So, this slide, and Jeff, feel free to add anything I might miss here, but, a core part of how we work is, LISC is Local Initiative Support Corporation. And so we work with our local offices where applicable for our funds. And so in this case, we are partnering closely and have been for really the past year and a half with the LISC KC office. And then we're planning on how we would operate these funds and kind of share roles. And so I think our most successful funds is where we have some local knowledge or relationships. And in this case, the coalition that LISC KC has built along with Mark around this fund is critical. And so what they bring is, the local knowledge, the impact needs, sometimes on a neighborhood by neighborhood basis or block by block basis. The initial coordination with funders and donors and government partners and stakeholders, that's critical to having these funds be successful. Then for LFM, we take more the really investment management approach from the taking intake and investment committee management, looking at the deals from a credit risk and risk perspective, the full underwriting component of this. We work because we're a registered investment advisor, we have the ability to raise large amounts of capital from banks and work within like SEC guidelines, and then kind of manage the governance structure of the Regional Housing Fund. Next slide, please. So now we'll come back and get a little bit more detail on the Regional Housing Fund. And just, high level, we operate 12 funds, as I said. I think there are things that make this fund very innovative and unique, not just in the Kansas City region, but nationally for us as well. So this is a regional fund, and it is rare to have funds like this operate in multiple cities, but multiple states, 9 counties. I think it's like 81 municipalities. So this is very much a regional fund, and we want to emphasize that. And that's what we are kind of explaining to investors and potential partners, and they are excited about that approach. And I hope that we can model something like this in other areas that, span states like, South Jersey and Philadelphia, or New York and Connecticut. There's a lot of opportunities, and I think we are trying to already take lessons learned from this approach. The second piece is, while we welcome government partners, and I know there's a lot of representatives from the government in this room, the fund isn't designed to take, public money. We have other funds where we have direct investments from cities or states or trust funds. This fund is really to operate alongside those public dollars and the public support. So that also is a unique aspect of this. The final piece is that this is a locally led approach with that working group that was on an earlier slide with the leadership around the foundations and this coordinating committee. This is very much local. And we've started the fundraising really with local foundations, local banks, local corporations, and we're just now getting into more national partners that are interested in this fund. And so the three of those, I really think, make this fund very exciting and something that I think will be a success. So we can go to this slide. This just kind of introduces some of the aspects of the fund around mission, purpose. High level, as Jeff and David spoke about, this is really designed to address the affordable housing shortage in the overall KC region, both for rental, for sale, increasing supply, increasing affordable and market rate projects. And that's what we're really focused on. The purpose is around access to affordability, community ownership, really providing financing tools that can spur different types of development. For geography, as we talked about, this is the 9-county region of the KC metro area, which I believe is a critical factor, and we could talk more about our strategy, how to access those regions. We're the manager, the capital structure for this fund, I'll get into a little bit more, but it's a mix of charitable debt, mainly from bank investors and PRI, preferred equity, potentially common equity, but right now we don't anticipate that immediately, and then grant capital. If we can scale this up to the 100 million and have capital recycling, which we expect to impact between 3,500 and 5,000 units of housing. And typically our funds are leveraged 3 times. And so what that means is if we put $1 million into a project, usually there's two other $1 million that are also going to that project from other sources. And so we're about usually 30 to 35% of the capital stack for any typical project. And for the timeline, I have another slide that goes a little bit more detail, but we're looking to launch in Q3, so late summer of this year. And our goal is to get to 40 million in committed capital by then. And then get to the full capital raise of 100 million by December 2027. So this just goes in a little bit more detail about the timeline, and a number of these overlap because they're kind of activities that coincide. But right now, starting with Q1, the focus was on the seed funding or anchor capital, really from the participating foundations and some initial bank partners. And so we have definitely, I would say, soft circled this amount, 20 to 30 million. We can get into more what firm commitments we have at this point, but I think we're in good shape in terms of that seed funding, and at least that we are able to get that. Ongoing is deal sourcing and fundraising. And so we want to launch the fund with kind of projects ready to fund and then have an idea of what that pipeline will be. So this deal sourcing piece has been, ongoing by Jeff and his team and our team for the past year, really. So I think we have a really strong pipeline of over 50 million in projects that are ready to fund in the next year, and that'll keep revolving and rolling, as you know, with project life cycles and funding rounds and things like that. But that's where the focus is right now, and also ongoing fundraising. To launch the fund, we're targeting a $50 million fund launch, but really, I think we would be prepared to launch with 40 million capital raised, but we're shooting to get to at least 50 million when we launch. The idea is that we launch the fund with that amount, and then we continue to fundraise really for the next year and a half to get to the full 100 million. That's been consistent with our other funds, and a lot of times, once a fund launches, there's a lot more momentum and excitement, and we can see real projects, and that's where we're able to execute on the rest of the fundraising strategy. We can go to the next slide. So in terms of the fund products, these are essentially the services or loans or investments that we're doing into the communities to developers, to borrowers, et cetera. We have three buckets. One is around kind of construction loans or other types of loans during the construction phase. That'll be the majority of loans from the fund. We have preferred equity, which we are able to invest equity in projects, get a little bit higher return, but this is definitely something needed, especially for bigger projects where they're not able to get pricing at this level for preferred equity, and we think we can provide that. And then a more innovative part of this fund is the idea for forward purchase agreements, where we would help a developer essentially give them an exit once the project is complete, that the fund would purchase that property and partner with it essentially to get it to a phase where there will be another refinancing or takeout at some point. But this could allow projects to move forward that might not be able to move forward, especially on more about the affordable lens. So going back up to the top with construction loans, so this is everything from acquisition to construction to kind of rehab, some mini perms. We bucket it in construction just because it's easier to really explain that it's the construction phase. But for the real estate people in the room, we show some of the debt service coverage ratios that we would do, the loan, the cost ratios, our projected interest rates, and we kind of give a big range right now, obviously. The terms of these are around 3 years, or usually 2 to 3 years, depending on the construction timeline. Preferred equity, these are higher rates of return for the fund because it is equity, so it comes below debt in the repayment schedule. But we do, 8 to 10% is what we're targeting for those preferred returns. And that is well below my understanding of the market right now for those types of projects where they're definitely into the low to mid double digits. And so we hope that can entice more market rate developers to do more affordable units within their developments if we can offer preferred equity at those rates. And those are longer term, usually around 10 years. And I spoke a little bit about the forward purchase agreements, but happy to go into more detail on that. So I think we can move on to the next slide. So here we talk about the key impact scoring matrix, and anyone from the Mark or List KC team, please jump in. But essentially, I said we are an impact first investor. So this was one of the first activities that we did with the founding partners and the local stakeholders, is really looking at what are the key impact areas of this fund and how can we make sure we're managing to that when we design projects, when we look at the underwriting, when we kind of forecast. There's a much more, I would say, robust version of this. This is a simplified kind of summary of our areas, but they're really based around the developer experience, location and neighborhood impact, the project or development side, and then the additional impact. And the idea is that we expect to have more demand for the dollars than we have available to lend out or invest. And so we want to make sure that we are investing our funds, assuming risk equal or risk adjusted, into the most high impact projects that we can in the region. So for developers, really emphasis on community-based developers that have a local presence. I know we will work with more regional or national developers, but we definitely would prefer to have as many community-based developers as possible. Experience in affordable housing is a critical must here, but we also want to entice market rate developers who haven't done affordable housing, but maybe they can execute that in some of their projects. Pipeline of deals, and then obviously, more around diversity and inclusive natures of developers as well as a critical part of what we're trying to do here. Location and neighborhood impact, the need for affordable housing or even market rate housing. There's some areas, as you all know, that we just need more supply. It doesn't matter if it's affordable or market rate. There's just not enough supply for anybody. And so that's kind of a balance we're trying to have. Proximity to transit, where applicable, local community and government buy-in, especially around affordable housing, is critical in what we've seen in other funds. And then there's a lot of other work, going on in a lot of regions. And there's neighborhood plans, there's business districts, there's strategic plans. We want to make sure these projects are aligned where it makes sense. And then the projects / development side, mixed income housing. And so, we'll have a lot of affordable only housing, but we do want to encourage projects that are mixed income, where we have a balance of unit types and affordability within one building or one area. Home ownership and wealth building, whether it's single family or other types of models, for sure. And then family-friendly units. Family-friendly units is something that is definitely overlooked in a lot of markets around affordability and affordable housing. 1 to 2 units are the norm in affordable housing and LIHTC deals. And so we would love to have units or homes that are 3+ bedrooms. And then finally, additional impact. We're just project viability. Are these projects ready to go? Because timing is, in essence, and affordability. We want units online as quickly as possible. And then around energy efficiency and sustainability is just a core factor in a lot of what we do and a lot of our underwriting as well. So broadly, these are the key impact areas, and we're happy to share the more detailed spreadsheet. You can see how we really look at other variables as well, but I think this summarizes it pretty well. And I believe this might be the last slide before we jump into some other areas. And so I talked about this before, but this is the target capital structure for the fund. And so it's made up of grant capital, preferred equity, and then charitable debt. The grant capital, we're targeting up to 30 or at least 30% of the total fund size. And that really allows us to obviously bring down the cost of capital for the fund, but cover expenses at the fund level, ensure we're having the programmatic efforts that we need to have, and help in the early stages of the fund's life while we're still raising traditional capital. Preferred equity and charitable debt, these usually both come from financial institutions, and it's a mix of CRA banks who have community investment requirements, corporations, hopefully more, and also PRI investors who want to structure their investments as equity or debt. But this is how we intend to raise the capital. It could shift, based on market demands and pricing, but right now this is what we're targeting, and we think it's still realistic. Okay. I think we can move on from here. So for this, Amanda and Hannah, you might jump in here.
Yeah, before we move on, any questions on the actual fund structure? And just to clarify, that last slide was the money that goes into the fund, not the money going out of the fund.
Okay.
Correct.
Anybody else? I can listen, I'm heavy-headed. Maybe it'll answer somebody else's question. Okay, so my first question, going back to the original slide that Carly had talked about, the fund structure and what it's attempt to meet the needs of. A couple of those needs I didn't see outlined in the fund structure itself. One of those being the subsidized projects, so subsidized affordable housing. And so within the key impact areas, and I'll say my second part of it, where do you see nonprofit partners or that being a part of that structure? And the other group that I wanted to bring out is the rehab and the maintaining the housing part, because on the far end of the structure, it is you own your home. But one problem we have in this region is the ability to sustain through a variety of remodel needs or aging housing needs. And so how does the fund on both sides of those spectrum? I heard a lot of how it builds and supplies, but I didn't hear the affordable subsidized part, and then I didn't hear the sustain and maintain the current housing stock market part. And so I guess those were the parts to me that really stuck out as things that I didn't hear. So if I need something.
I mean, maybe I can start and the team jump in. I mean, I would say, so the fund is agnostic to all parts. So it's designed intentionally to be able to serve a preservation need or a production need. And so if, we intend there to be a blend of both. Like, we fully understand the benefit of preservation, and both from as a fund management side, it's also significantly cheaper to preserve a unit than to have to build new. So the fund does allow for both preservation and in the modeling that Adam and the team have done, it has a blend of both. I forget what the actual mix is, but it's something like 2/3 probably production and 1/3 preservation, something roughly like that. Maybe 75-25, I don't remember. So as far as the nonprofit, what I would say is it's also agnostic intentionally for that. So we intend for nonprofits to be using this fund as potential low-cost capital, but it is also eligible for for-profits. So oftentimes you see funds that are only targeting one or the other. This fund is all of the above. And so I think part of what has taken us a minute to kind of ensure like our initial funding and investor work group is comfortable with like the parameters of the fund is that we wanted it to be fairly flexible in who could be borrowers. Now, it also is agnostic in whether it's a multifamily or a single family.
I saw that.
So, now I do think it will lend itself to, more than a just single family one unit development. Like, I think it is more likely to us to see multifamily units coming through this fund. But it is flexible, so it can serve both. And so, I'm sorry if we didn't talk about it as much, but like it is intended to support nonprofits just as much as for-profits. The overall fund investment we've committed to is having at least 51% at an 80% AMI or below, and across the fund's entire portfolio. So there will be some units where we might have 60 or 80 or 100% of the units at an affordable price point, but we may have some where it's 10 or 20 or 30% at an affordable price point. And to kind of one of your earlier questions about geography, I think like part of why we designed it that way is to encourage. Right now, there's like a natural bias towards building affordable units in lower income census tracts. And part of what we want to do here is actually incentivize diversifying and deconcentrating those affordable units into other parts of the region so that Johnson County, so that like Lee Summit, so that Liberty have opportunities, so that downtown have opportunities for affordable units, not just not just the 3rd or 5th district in Kansas City, Missouri. We want to ensure that there's affordability all across the region. So,
I don't disagree with you there, but we have heard that many people don't want that. They say they do, but then they don't want that. But I hear what you're saying.
And part of why we've structured it so that the fund portfolio can have this blended is that we may go into a community where if you came into some neighborhoods and said, I want to put a LIHTC, as our friend at Habitat have found, you get some, not even a LIHTC deal, you get some pushback from the community. Well, so what we're saying is if we blend it in such a way that we may go into a community, and we've done this in other markets that LFM has, where they can go in and do 15 or 20% of the development at an affordable price point. It doesn't trigger the same level of NIMBYism. And so you can start to kind of like seed affordable units in different parts of the community without it being an entirely affordable project, which then riles up some of the NIMBYism.
So the other thing I'm no developer, but I wanted to make sure utilizing some of the data and the information, you see the needs of what you heard from the developer study. I didn't go deep in the weeds with that study. being addressed here for the small mom and pop. And I heard you about the flexibility of the one or two projects, but I also heard in the developers survey that was the hardest thing for smaller developers was capital access, all of the fees. Do you see those needs being met in the way that this fund is being created intentionally?
So I guess I'll start again. I mean, I would say, I think it is less likely that we're gonna see a lot of small mom and pop borrowers to this fund. I anticipate like part of like the opportunity with community cares is to do some of that infill development with kind of a smaller incremental developer. Where I think this fund, the fund has the ability to do it. The question is.
My question is, we asked them for their feedback and said we were going to try to create something, and I just want to prepare myself for us for that. Like, we asked you for your feedback and took all of this time, and then we created a fund, and it doesn't meet the needs of what you said you needed.
Well, I think there are specific tools that do those. So
And I know this isn't the be all carry all, but it also
I mean, that's.
the intent of that RHP study. So
Sure. So I think there's a couple things. Like, I think the preferred equity tool is part of a direct response to some of the feedback from developers. That there's a challenge finding, concessionary capital at good rates for preferred equity. I talked to a developer last week who told me that they had a preferred equity investor who was asking for 21% return on their money. Well, that's ridiculous. So, we have the ability to essentially come in and make an investment at 8% or 9%. And so the preferred equity tool is designed to help some of that. The other is the forward purchase agreement that we touched on, which I think also gets to maybe a little bit of Pat's question that I kind of cut short, and I apologize for that. But like,
Jeff, I forgive you.
the forward purchase agreement is a potential tool where you might have, an incremental developer or a smaller developer who says, I've developed 5 units. The fund could potentially come in and buy those 5 units and serve as the purchaser at the back end, which then helps them have opportunity to get capital to actually do the construction, knowing that there's essentially a buyer at the back end. So that forward purchase agreement was also designed intentionally to be a tool that would support kind of the smaller incremental developer.
And that was going to be my question too, Jeff.
Which would also support potentially your construction.
Yeah, we're focusing on 1 to 12 units primarily in underserved communities. Unfortunately, right now in Jackson County, the 3rd and the 5th district.
don't say unfortunately, that was very intentional.
But because we do want to grow,
Yeah.
the small scale developers loan fund. But just like with anything else that's innovative, especially in our beloved Midwest, folks want to see proof of concept.
Yeah.
So we have to do that first and then we want to grow.
Agree.
So
My last question was just around the fund administration fee percentage from whether that's you all, whoever's paying these people. Do you have a percent that you are capping it at or staying in? I know many funds start there, so then you're not fluctuating what you're taking on the back end or saying, well, it's so successful, we decided we're gonna take 10% instead of the 6% that we started. Have we established that, or that fund group, did they establish that prior to all of these pieces?
So yes, the established was up to 3.5% of the assets under management, I think was language. I could be wrong on that, Adam. I think LFM has actually proposed a slightly lower fee. I think they're still working through that. So, but up to 3.5% was the language I believe the initial work group came up with.
Thank you.
And do you want to weigh in on any of that?
That's correct. And we have a draft term sheet that we're sharing with investors, and it's, right now up to 3.5%. It might be reduced to 3.25%. And essentially, for the first 5 years, that's based on the committed capital. And then thereafter, it's based on the investments outstanding. And so that's where the performance piece is like, we need to actually deploy this capital to earn that management fee.
And you
There is
typically-
no, sorry, Jeff.
Sorry, I didn't mean to cut you off. I was gonna say, because I thought it was, I think it's a good important point. You actually drop the fee after the first 5 years, like of almost a full percent or more. for
That's
the
correct. Yeah,
remainder.
exactly. Yeah, it goes down to 2% after year 5. So there is, yeah, this reduced nature of the fee, and and we don't have a carried interest or performance bonus. So it's just purely management fee component, which reduces the amount that we get and increases the amount we can put into the community.
If you could fast forward to the slide that shared the guidelines for the distribution of the fund back when they talk about the scoring category for the developer neighborhood project development, probably along with Rachel and others, I'm listening to hear we don't really want to see Wyandotte County left out, but we oftentimes don't see benefit come onto the Kansas side quite like we do on the Missouri side. And I recognize Missouri has a lot of need for housing, but in Wyandotte County, as you all probably have heard on the news and in other places, we have over 4,000 land bank lots, and a lot of them are centered in our first district, which is our historical Northeast area. And I am privileged to be part of the council, but I am one of those incremental small developers in Wyandotte County. And I can tell you that the inability to have access to funding is probably one of the most critical parts of development. And personally, I'm working on a development that could be 27 homes, but in a neighborhood where there are 31 vacant lots in a 5-block area. That's a lot of vacancy.
Yeah.
But as a developer that is still only 2 years into development, my lender limits the amount of money I can have out at one time. So I had other houses in another part of town going, and so I started with three houses in 27 lots is like crumbing a neighborhood, in my opinion. You're crumbing the neighborhood. But if I could do a block at a time and a block at a time, then I have created critical mass, critical really impact in a neighborhood. So I appreciate this. And then from a selfish standpoint, I'm looking at those boxes and seeing where do I fit in on that. But then I kind of leaned over to Jeff earlier and I said, is this just going to be a money grab? Because where I can see that larger chodos or larger non-for-profits are going to have maybe a different opportunity to secure funding versus someone like me that has 11 houses under their belt and 24 more to go. So what do small scale developers, not even small scale, because I don't think I'm small scale per se anymore, have been, but my goal is to develop 100 houses in, a short amount of time. But what does this look like for smaller scale developers that are having an impact in parts of their community that fit a lot of those boxes?
I guess I'll start again. We are hopeful. I mean, first off, Carly would kill me if we don't invest in Wyandotte County. So yeah. So, I anticipate give us a year of the projects. I don't know where the first couple projects will be. I will say there is a natural and one of the slides, I think we haven't gotten to it at the end, is part of what we can also get from you all is help finding those projects in areas that have large public investment like Casey Mo, have kind of a natural pipeline of, kind of affordable housing developers who are seeking those public subsidies, right? And so it's easy to say, okay, well, here's 15 folks who went after CCD or CDBG or housing trust fund dollars. If a community doesn't necessarily have as much of that public subsidy, knowing who some of those developers are is a little less obvious in some cases, obviously, you know, you can go after LIHTC and stuff like lists. But, you know, so part of what we want to do is like, we have, as Adam mentioned, a fairly robust pipeline of projects all across the region that we've kind of been tracking and just watching, or developers, you know. But we do notice that they do tend to slant towards areas that have high public subsidy. And so, you know, to the extent that you all can say, well, look, here's a developer who's about to do 35 units, you know, at whatever, 18th and State. And I want you to talk to them. Like, I think that's a role that the Coordinating Council could help us with and make sure that we're aware of some of those other projects. The fund itself, we are only going to be a small portion of their total capital stack. So we say $100 million, but we're anticipating that the average investment will be somewhere in the $3 to $5 million range in a project. So we're still anticipating even a large developer, you know, who's building 200 units and they've got, you know, whatever that is, $50 million project. We're going to say, you go to the bank for the other 80% of that 50 million. So there's 40 of it. We might help you cover 5 million of your cost with cheaper concessionary capital. So you're not paying double-digit equity investment. In exchange, we want you to add some affordability. If you're going to use our money, you got to have some affordability in your project. And so if you were only doing a market rate deal before, maybe they say, well, you know what, we'll add 25 units of affordable price point into the deal, and we're in it for maybe $3 to $5 million. You know, and then the rest would be their own equity investment. So, you know, we're not looking to fund the big construction costs. I mean, construction is a piece of it. We certainly can do it, but like on a big developer, you know, they're going to have access to traditional debt financing for that piece. So I do think like a smaller developer, we're hoping to be able to, you know, get as many kind of submissions as possible. We certainly want to sit down and support as many different types of projects as we can. And then geographic diversity is important for our funders as well. Like they've been they want to see the fund investing all around the region. And so, you know, that's a space that I think you all can help us with. And it may be a combination of you've got traditional bank partners, and then, you know, the fund comes in and provides some of the equity, or it's like they'll only do a certain amount, but we could do the rest from the fund. So I think those are things we can work through, have conversations about.
To Rachel's point, that we ask what people want, but then we want to make sure that the reality of the delivery covers
Sure.
the sincerity of the request.
I mean,
and the
I
data.
think, I mean, you spent a lot of time on the developer needs. I believe the fund addresses the issues that were raised through the developer needs assessment. I think there's always some movement on the edges a little bit with like your investors and kind of what they feel comfortable with. I think a lot of times the developers will say, we need cheap capital, we need equity, you know, we need flexible capital. Like they say all the
Straight grant.
yeah, we just want grant dollars. Like the fund won't do grant dollars. You know, and that's you know, to one of Adam's points about like the public subsidy, I will say, because we've got a couple of elected officials here. One of the things we've been telling communities is an opportunity to work inside the fund is you can still invest public dollars into a project at the project level. So it may be, hey, there's a project at 135th and Quivira. I'm just making up an intersection here. You know, the fund may step in and say, hey, we're going to do $3 million into this project over here. But Johnson County or, you know, Olathe may step in and say, but we'll put 500,000 of public subsidy into the project at the project level. And so there is still an opportunity to partner and work alongside our public partners. I think why we intentionally don't have public money in the fund itself is some of the lessons learned, obviously you all have seen. There's some uncertainty sometimes with government and government funding sources. And so, you know, in some of the funds we have where we have dollars invested from the public, there's also a little bit of like, we want a certain number of projects in our community, in our neighborhood, in our city. And where, Adam, you're a little off, we have 119 cities in the 9-county region. we wanted to make sure that the fund was agnostic to kind of any geographic footprint, and had the ability to, and wasn't being so deferential to only where the public agencies were able to make a substantial investment. And then we were, kind of having to defer only to those geographic areas. So, but I think we're going to be able to accomplish a lot of what was in that developer needs assessment, my hope. That was the intent.
I want to add to it, but where it to set expectation and where it doesn't meet the needs of what's in the developer plan is around grants, emerging developers with no experience and no balance sheet. And then also around the emerging developer training. So, but with the training and technical assistance for emerging developers, that's other pieces of the regional housing partnership. And something that we've also been trying to get funding for is a training program, a month-long training program that essentially acts as the Urban Land Institute's Ready program, kind of like a phase 2 or something that acts alongside of it. So this fund does not address that, but there's those other pieces and parts that do. But with those emerging developers with no experience, no balance sheet, honestly, like we're not going to be able to underwrite that. Adam, correct me if I'm wrong, but we're not going to be able to underwrite that unless there's partnering with a developer with more experience or there's deeper subsidy from other public sources. But that's really where community cares comes in, and that we would support, that effort, because you guys are there still is that gap. Like this fulfills a gap between traditional capital and philanthropy, a pretty good gap, but there's still that gap in emerging developers. And correct me if I'm wrong, other people, but if it will only meet that need if they are like partnering with another developer that has experience in the balance sheet. So also just want to set that expectation too and say that that's where this doesn't meet the need of developer and the developer needs assessment. But that those sidecar things, like hopefully will with that training program. And
I didn't mean to talk this much, but I will say also, we are also trying to find and work with some of the foundations around, like, could they develop a guarantee pool that then would support some of that, need for help with some of the collateral, for in situations where folks are just starting. So this fund won't be the single solution for all housing needs by any means, but I do think it will address a significant portion of our needs and at least get us as a community kind of moving down a path that then allows for us to also address these other kind of tangentially related matters.
Okay, I'm going to hit this slide now. So this is essentially the last slide, one of the last slides. So really in how we're coordinating and working together with Regional Housing Fund and the Coordinating Council. So the Regional Housing Fund will have an investor advisory group that is of the investors. Alongside that is how we want to engage the Coordinating Council. So as Adam said, like this is really locally driven, and it has the huge benefit of having the funder work group informing it, as well as the Coordinating Council here. So the biggest pieces that we saw of Coordinating Council having an impact and playing a role is around project pipeline, ensuring that there are projects that are geographically diverse, as well as market rate, affordable, and mixed income. So if you're a local government, you will be hearing about a lot about developers who want to build or rehab in your jurisdiction. Tell them about this. If you're a banker, where'd Take go? Central Bank does millions of investment in affordable housing projects. And we also, I won't say more. But we definitely want to work alongside them in financing those projects. So if you know other bankers who can come in and also invest in these projects. If you're a nonprofit and you have partners who are even doing, if there's permanent supportive housing or market rate housing that you're partnering with or anything in between, we want to know about that. And I think that's what we view as one of the biggest roles, is like being ambassadors for the fund, and then also driving developers to this fund. And also sharing local context on projects and developers. If there's somebody who you strongly support or strongly don't support, like, we want to hear that, and we want to hear that before it goes to underwriting. So I think that's another crucial part, is who and where and what the reputation is, and the public sentiment around it, though we know public sentiment can also be NIMBY. But we want to know any other local context of developers and projects. Also around ad hoc problem solving or brainstorming. So if for some reason the fund is only getting market rate projects in Johnson County, which that's not going to happen. But if for some reason it was some like weird extreme like that, like, we want to problem solve with you. How can we get the word out more to specific developers? How can we talk to local governments in these areas? How can we help encourage specific developers or locations for these projects? Or mixed income, how can we bring mixed income into these particular areas where we're not getting into yet? So definitely want to be, I think that's another good role for the Coordinating Council. Then the LISC and LFM kind of like role and responsibility. So there'll be an annual report. Can also deliver an annual presentation. And I know the Coordinating Council's Action Plan Subcommittee, maybe it's something that is, maybe the presentation is aligned with that. So we're measuring like the metrics and just making sure that those metrics with the fund are also aligned with the metrics of the Regional Housing Partnership Goals and Strategies document. Also adding some of the projects that are affordable, or units that are affordable, to the KC Housing Locator, which is essentially, I think, owned by KC Mo, but is for the region, and that RHP helped to launch. The underwriting and vetting of projects is LISC, LFM, fund level, all of the other stuff that was on this slide that LFM does, investor relations and asset management. LFM. So on the next slide are just some kind of key takeaways for you all, and we can share this out. But I think some of the things that really differentiate this fund are these pieces. So it's creating the civic asset, the civic infrastructure that supports different initiatives and projects, and like some of the Missouri cited KC Mo focused projects that we listed that we always get asked about: driven development, trust neighborhoods, the KC Mo Housing Gateway program. This can support some of those things. It's for the whole 9-county region. Mixed income. We're not calling this an affordable housing fund because it's mixed income. Multifamily, single family rental, owner occupied, new construction, rehab. Financing through both debt and equity, that is privately funded. So those are just some of the, I think, key differentiators for other things out there. And then any other questions, just send people to us. Anything else, Jeff, David, Adam?
I mean, I will just say, I mean, we've spent a lot of time on it. We hope it certainly reflects kind of like the needs in the community, but it is intended to also be responsive, and you know, so if there are things that you see, you know, missing, or as we get underway, you know, we want to kind of have that continued engagement and see what we can do. Obviously, you know, we also have investors, you know, that they've kind of given us a credit box of where they're comfortable. Banks have certain regulations that CRA requires of their investments. And so we also have to kind of factor in all of that, you know, blend it all together. But you know, we're really excited about it. I think that the LFM team is really excited about it. You know, they've been out here a couple times to kind of meet with some developers and you know, meet with some of the investors, and so, you know, and they're getting better at picking their favorite barbecue. So, you know, we're hoping to get.
These slaps.
And try that.
Oh man, Slabs is great. So yeah, we really support, appreciate, I think, your all's work on the RHP like broadly. But, you know, the input that you all have helped us to provide, you know, in different contexts, you know, as we've shaped this has been critically important. So thank you.
Thank you for your work.
Can I ask a question?
I don't want to sound like a broken record, but I'm gonna come back to, you said the fund was gonna launch in Q3. I would personally, like, part of my coordination, my thinking is that you would have interests, like you'd say, hey, we're launching this fund, but then you would have interest meetings that are specific to some of those smaller groups of people that we're talking about. So like maybe there's an interest meeting that's specifically for nonprofits looking at subsidized housing and talking about potential ways the fund could support it. Thinking to Fran and the small developers who, and her over here, like how the fund could support them in stacking the capital, like having some of those intentional sessions specifically for those folks instead of the broader, like, everyone can come and learn about this fund session, because I think there are gonna be some niche things that maybe you all don't know, or maybe that those folks don't know is possible, that they'll be like, oh, they're just gonna give their money to all of those others, so I'm not even gonna bother. But if we're intentional on the front end, it'll require less of all of us to go and like try to source those projects. I'm also gonna say, in 2027, as the co-chair of the annual convening, I'll be following up with someone to talk about the launch and the project at that annual convening. And then like my future Rachel loves to event plan self is thinking about the fund activities. So 2 years from now, 3 years from now, when we have projects that are built, where do we access funds to be able to showcase the things, like getting people on a bus to go showcase the things that the fund has supported, very similar to like the CDBG thing that KCMO does. I'm trying to get Johnson and Wyandotte to like rally the troops and let's make it happen. So, yeah, because I think people find those very valuable to know that you talk about a lot of things in Kansas City, people don't see it. And when people see things, they're like, okay, they're actually doing something. So, and then also a great way to show off your projects that you've supported. So.
I have a comment about this. I think this is going to be really crucial because in our city in Overland Park, we have projects that we have approved that we have said we would like to see 100% affordable housing of different, units and costs, studio, 1 bedroom, 2 bedroom. And those have been sitting for years without any activity. And I think they're not penciling, the money's not money. So I feel like this is a great tool to help maybe make those equations work out to get those units built. And what has been the holdup, and has it been access to funds? Because it doesn't help if we are making all these zoning changes and nothing's happening. So
We've had some really good feedback from market rate developers who I don't think of as affordable developers.
right.
Who have said like, as long as this pencils, like it gives me, like some of them are less than, so they're
Yes.
driven by the return. But many, if it still pencils for them, they're happy to include affordability, because then they haven't always found their way into having affordable in their projects, but not always because they don't want to, it's still their
It's new,
path,
that is a new concept for them to be thinking about. So having other money opportunities to bring to the table, I think it's always going to be a good opportunity for them. But yeah, I would rather see these things get off the ground.
So to piggyback off of that, I also wonder if there's some real genius in it's a market rate development, but this provision in your capital stack is where you're going to get these 5-10% of affordable units. And that's not what anybody at the planning commission or the city council is focusing on when you're approving these things, and no one has to know that comes out with their signs.
Right.
Because it to my mind shouldn't be any different than any other capital stack for a development that comes in. Do you meet the land use and zoning requirements? We're done. I am curious about what the affordability terms are, particularly for rentals. I mean, I'm thinking about LIHTC and some of these other programs that have really long-term stringent affordability requirements. And that might be where the rub comes in with some of these folks who aren't as well-versed in doing business that way. How do we move forward that way? How can we help educate people? And what is the expectation sort of after the project's complete around affordability?
So I would say we want to engage with the developers. We often find kind of one-on-one that's much easier to walk through with them. Like you do hear, so it does, by having a deed restriction on an affordable, like a certain, say 10 or 20% affordability, right? They do reduce their rent rolls. So their income, the rent comes in slightly lower, which does change their DSCR, the debt service coverage ratio, a little. But we have to also have banks understand why their DSCR is coming in slightly lower. And then ultimately, if they go to sell the property 5-10 years from now, and we've asked that they have a 15-year deed restriction, they're going to get less money when they go to sell the property because of that deed restriction. Knowing that, I mean, that's all that they can calculate, that present value of that cost. And so, but having that conversation, just kind of working through with them, like, here's the trade-off, but we can give you some cheaper capital now to get your project across the finish line today. And so, versus, I think, we think we can work through them. I think, LFM has typically been able to do that in other markets. But it does have some financial impact to the developer long-term.
I think the foundations that are investing in this are keenly interested in making sure that affordability is there for the long haul.
Yeah.
And so these safeguards will be built into every deal, that if we're investing in affordable units, that they're going to stay affordable, whether LIHTC or something else is involved or not.
So you're doing deed restrictions as the mechanism?
That I gather is a preferred. There may be some other ways to.
Like, ideally, we would tie into any government subsidy that might be in there, but if there was no government subsidy, I think the thought would be to probably do a 15-year deed restriction.
If it's a LIHTC deal, which this could support, then it's already got that built into it for.
Everybody hates the red tape until it's really convenient that you don't have to make it.
Think of a way to structure it so that some of the investment is in community land trusts to work with that affordability and perpetuity model.
Yeah,
Great idea.
Yeah, I mean, I think we are happy to. I think any shared equity model we are happy to try to invest in. And that has been a space that have been less obvious for some of our bank partners of, like, individually. So I think that's also an opportunity but the fund can do that.
I'll just add, LFM has experience doing community land trust models and loans in different states. And I think we have a pretty good underwriting system and we understand those types of projects as well. And I'm personally a big fan of those models. So I would love to, discuss more, even learn about the pipeline of types of projects in the region for CLT.
I actually was just going to ask, kind of in terms of the timeline between now and launch date, is there any specific way that we can be supportive or helpful as we prepare to launch this?
That's great. Let's leave that as an open question. I don't know that we have an answer today because the launch date is still a little soft. It will depend upon the right amount of capital coming together, but we are really intent on getting it off the ground this year. And so that's a great question around, let's engage this group when we get closer to that, to have that requires a conversation and some thinking about the best way for the word to get out. But I think you would be very helpful in that process.
I missed what you already had committed already.
So we just got some money in yesterday. So we're at 10.5 million kind of in hard commitments. well, maybe if we count, maybe 12 if we count one of the bank partners. And so then, you know, but we've got about, I think, 30 to 40 million kind of in requests being considered, and like, I think we need to lock down some of the banks. But we want to get, and we have a little bit more on the foundation side to try and raise to get to where we need to be. Obviously, pipeline wise, we have a robust pipeline, but just staying attuned of any projects or opportunities, because what we don't want to do is launch and then it be 12 months before we make an investment. Like, our plan is launch and invest in the first couple projects immediately, so that we can start to show how the capital works and deploy it and test to make sure it's working the way we intended to. So, you know, we're trying to stay up on kind of where projects are, who's ready to go in third quarter of this year. So you know, I think, but let's visit more and see if there's some specific things. But I mean, the local banks have been very supportive. Foundations have been very supportive. So, you know, I think we've really got a good group of kind of core investors and stakeholders.
Okay, great, thank you.
I was also just gonna piggyback off of something you said. Maybe, and I haven't been to the RHP website since like the little kickoff thing, and I heard somebody say y'all made some widget changes so that it works. But maybe there's like a info fill on the RHP page where I have a project and I might be interested in the fund, that then it can like shoot that to Carly or something to know to schedule those meetings, so that it's also like a specific place we can tell people to go, or like, hey, have you heard about this? Fill this out and then someone else follow up versus the email thing. I don't know, just an idea or something thinking about.
I think Regional Housing Fund will have its own site, and because we were just talking about
Who does the local connection for those things though? Because I saw that in their thing, but who makes the local connection?
So anybody on our team, certainly, but probably the person that will be most involved is our loan officer, Jeremy.
Stab, I mean,
Yeah.
sorry, Stab, sorry. Do
So
whatever.
Jeremy and like, so on the intake side, like Jeremy and Ben Gillespie on the LFM side have been like the ones meeting with developers the most. They've got like a little intake form they've been filling out. So we can certainly visit about how to make that more public.
I think putting something on the RHP website. Even if it's just a link.
Yeah.
To whatever
RHP,
Jeremy
right.
thing is, yeah.
I think Christina, did you have a question?
Heard a average loan or average investment, is there a minimum that's going to make sense for this particular fund?
Adam, I don't know, have we talked about a minimum investment size?
Great.
That is a great question. We don't technically have a minimum loan size. I would say the average we're planning is between 2 and 3 million right now for an average investment size. But I know that we would do loans at $1 million, slightly under if it's a high impact project. So I think there is a lot of flexibility there, but ideally it would be 2 to 3 million on average.
And I forgot to mention on the RHP Coordinating Council roles site slide is we are creating a non-binding operating agreement that just talks about those different things and lists those different things between Coordinating Council and LISC LFM. So we should have that for you all to review, and if you choose to adopt it at the July 9th Coordinating Council meeting.
Is there been any conversation about the cost of the loan? Like will there be an origination cost associated with it, and what does that look like?
Yeah, so we'll have product sheets and term sheets that we can distribute. But generally for our loans, we would look, I don't want to go too far just because there are some restrictions on what I can say, but in the slide, we put a range, I believe, between 5 and 8% for loans. And then the origination fee, typically it's 1% origination fee at the loan level. I guess I can say that because it's on the slide. So. Sorry, we have all these compliance items, so.
Great, we're, I think, a little past our time, so,
You're till 11:30.
oh, we do, I'm sorry, excuse me.
Some pastries.
Well, thank you, everyone. We are having the RHP annual convening subcommittee meeting immediately following this meeting. So if you want to stick around, we're going to talk about that too. Thank you all. Thanks, Allison.
Thank you all. Appreciate the time.
Thanks, guys.
It's always virtual.
I don't know that we have.
I know.